Trading later in an upcycle. So I would say focus more on less obvious buy points. You know, the leaders, and I learned this from Oliver Kell. This is a really golden nugget. The leaders will be leading the overall market in their cycle. So that means that their price, where they are in the price cycle, whether they're breaking out versus pulling back, all that, they're going to be leading the rest of the market, the rest of stocks. So the stocks that are going to be breaking out from bases later on in a cycle, when you're already day 30, day 40, whatever it is, whatever late is for you, they're going to be more the laggards. The leaders will be basing, setting up pullback entry points, all of that. So you want to be less aggressive late in the cycle and stay focused on the less obvious buy points, because those breakouts are more likely to fail later on. There's less institutional backing behind them. And in addition, you want to overall do less. Let positions work for you. Size less later in a trend, because the risk is elevated, because we're more likely to have, it's more likely for the cycle to end and for the stocks to start breaking down and start a down cycle. What does late mean? We touched on that a little bit. Basically, what you want to do is go back, define your system, and study, what is the average length for an upcycle? What is the average length for a down cycle? What does it look like when a down cycle starts after, an extended period of an upcycle? You want to study all of this so you can pick up those clues in real time. And then you can decide for yourself, what does late mean? But typically early is, first few days, especially of a new upcycle. And then late is when you've already been in that for a few weeks. A lot of the leaders have already made solid moves, and you feel like you're chasing. You're not at prime buy points. And as I mentioned, position size should be progressively lower as the cycle extends. Ryan, anything to add on this slide?
Yeah, this one for me, it's most important because the way the math works is early in the cycle, you size, your size should be the highest. Stage 1, 2 traders should not full position size. That's not what we mean. Later on in the cycle, if you do place a position on, and if you're placing the same size as you did early in the cycle, what it will do is when that pullback happens, when the probabilities of a pullback happening are much higher later on in a cycle, you will experience bigger losses because things tend to move faster to the downside. Example of that right now, early September. Look at CELH. People that bought, you want to buy closer to that gap up, right? Where CELH had earnings, rallied from there. And we were fairly late in that upcycle. And then we saw a day where it went from it's basically gone from 200 to 160 in a span of 4 to 7 sessions. Anybody that got caught in that, we were late in that cycle. 2, if you did get caught in that and you think it was a good setup, everything checked off, things look good, perfectly fine. But your position size later on in the cycle should be much reduced so that the damage that you take later on in the cycle relative to the progress that you made early in the cycle, the math works out so that your equity curve continues to rise, right? What you don't want to do is size the same, and now you negate all that progress that you did. You did everything right up to that point, and the market's about to change its trend or go into this pullback mode, but your position sizing hasn't reflected the fact that you've rallied quite a bit. It should be a lot less so that when the pullback happens, you give back a little bit, not everything all at once, right? Pressure on the market and the stocks. So let's say you have 7 stocks on your focus list, 5 to 7 stocks on your focus list, and they're all pulling back in the same day, and you are a trend trader, you're experiencing a stress test. Another way you can experience a stress test is when you have 2 to 3 or 4 positions on and they've been working well, you're making a lot of progress in your portfolio, and you get that one day in the market where that everybody feels, right? Where you're giving back 2 to 3 days of progress in a matter of a couple of hours. That's a stress test. That's what you're experiencing is a stress test. The first stress test in the market, you always have to give it benefit of doubt. But if you start seeing multiple stress tests pile up in an uptrend or a positive cycle count, that's when you have to start getting cautious. That's the third point that Richard wrote down here is closes matter, right? On stress test days, You want to see how much progress you're given back, and on a closing basis, you'll have better judgment as to what you need to be doing the next day for the most part. And these are very, generalized, things about stress tests and what you will feel on those particular days. And you have to be mentally prepared. And how do you become mentally prepared? You become mentally prepared by journaling. So when you know that you expect some sort of turbulence in the market around day 7 to 10 in your market cycle system, then you will be mentally prepared that you're going to get a pullback. And when you're mentally prepared, you will look into closes matter a lot more. And you will say, okay, I had 5 good days in the market since my system says that it's a positive count. I now expect a pullback. Maybe I'll give back 2 days of gains just to see how things are looking. If you're up, 5 days in a row and you're giving that one day, you're giving back 6 days of progress. Obviously, you want to be cautious at that point. But all this does is, having that market cycle system does is it will keep you mentally prepared for those pullbacks, and you'll act a little bit more mechanically than emotionally as humanly possible.
Yeah, I'll jump in because I
Yeah.
put in a chart of the QQQ here. This is the 21 EMA, this purple line. This is the 2020 market correction bottom where we had the follow through day here on April 6th. This could be the start of your up cycle. And then I think it's about 10 bars later, we experienced this bar here. So think about what's happened. We started an uptrend. We're trending nicely. Things are working. Stocks are breaking out left and right. And then we start to falter a little bit in this area. And then this day is what we call a stress test, where in one day there's a lot of selling happening. But if you're mentally prepared, you're aware of your cost basis. You're ready for this type of event because you recognize, and this is realistic, that stocks just won't just trend up forever. There's going to be moments like this, and if you're prepared and mentally ready for them, you'll be able to treat it much more objectively and keep a hold of your positions. Because what happens after the stress test? We pass the stress test, and the market just continues to trend higher. So think about if you weren't ready for this, and then out of the blue, you see all your stocks down 3%, 5% in a day. You don't want to think emotionally in that sense and say, this market's just going to completely reverse. We're going to go down to bottom. We're going to do all that. You want to, think in terms of cycles, recognize that there will be days like this where there's some intermediate term selling, and treat each of your stocks on its own basis. And if they survive the stress test, great. Let's keep holding the position, see what works. If they eventually hit your line in the sand, that's fine too. But knowing that these stress tests will happen is basically key. So you don't overreact and basically sell your position prematurely when that trend is still in play and the cycle is just beginning pretty much.
And also one thing, what you may notice is this first down day that we see, maybe some of the stocks are just acting a lot worse than you think at that day. So at that point, you could anticipate, hey, the market's not acting well. My portfolio is not acting well. The stocks that I have on my focus list are not acting well. And when you get this day, yeah, you want to wait, to see how much you're giving back, and then, make a decision based on that. In this case, the market just, what people call a shakeout, right? Came back in, filled this gap area, next day gap up, and then it's on its way again. So
yeah, the key thing is be prepared and recognize that
yeah.
this can happen, so that you're continuing to follow your system, follow your process, and you're letting the stock work for you, instead of stepping in outside of your rules and just doing something because you're frightened or scared or think the world is going to end. Listen to your market cycle rules as well as your position management rules.